All right, this is video 9 in the beginner's guide to properly structured whole life insurance. And we're talking about how life insurance, when set up and used properly, can be a positive asset and benefit for you in the future. We call it retirement. I'm not a huge fan of retirement just because I think there's a lot of underlying negative things that come with the word retirement. But overall, you think of retirement being a future day that we're going to take the money that we saved and invested and create cash flow. We want to enhance that. And so I go through a couple of different strategies on how, when life insurance is set up properly, it can enhance that future. And that should be a benefit because whether you're near retirement or whether you're in your 20s or 30s and just want to have a good exit strategy in the future, life insurance is going to be a positive asset whenever that day comes. All right, in this section, we're gonna talk about retirement. And like I prefaced this whole course, I'm not a huge fan of retirement, but let's think about this being a financial freedom number for you to put your money in a place that it will show powerfully in your life. And right now, we live in a world that 8% is better than 7%. And I know what I'm gonna say is gonna be a little bit counterintuitive, but at the end of the day, we have to ask ourselves, what's our result that we actually want? And for some people, they're saving for retirement, and at the end of the day, they want to just get more cash flow in retirement. And I'm gonna show you the best way to maximize that. And I believe life insurance, when set up properly, will maximize that, and there's multiple strategies. And so I wanna give you an overview. This will obviously be when you work with someone, when you work with either a BetterWealth coach or someone, they need to have an understanding on how these strategies work. So I live in Denver, Colorado, and a question I love to ask people is, what's the goal of climbing a mountain? And what everyone says is they say, Caleb, it's to get to the top. And what's funny is that's what the whole retirement plan movement is. Their whole plan is to help people get to the top. You'll see commercials like, what's your number? And the whole idea is if you can earn a better rate of return to have more money at retirement, you're better off. But it's funny, if you're at the top and don't know how to get down, that would be a very unsuccessful journey in climbing a mountain. And so many people, if you look at what their greatest financial fear is, it's running out of money while they're still alive. And that should be a valid fear because very few accounts, the accounts that are touted as being retirement accounts, really show up very, very poorly as it relates to retirement. And the two reasons these show up poorly is losses and taxes. We have no clue what tax rates are going to be in the future, and we can't control losses. And this makes us, when we're near retirement, if we don't plan ahead, we put our money in things like annuities, or we put our money in super conservative accounts because we don't want to recreate 2008 where people were nearing retirement and then they had to go back to work because half of their assets got wiped out. And so because of losses, because of taxes, there's something what's called the safe withdrawal rate. And there's a key crazy word that I'll say, it's called sequence risk loss. What sequence risk loss essentially says is because of the chance for loss, we can only take out about 2.9 to 4%. And this is the safe withdrawal rate, meaning there's a good chance over 30 years you'll have some kind of money if you go into that window. And so right now, I'll just use 3% for an example here. Let's say you have $1 million. Let's say you're one of the few people that actually save up money and have $1 million at retirement. And by the way, that's a great job. Like, you did an amazing job. The problem is you sacrificed your whole life, saved up money in these accounts, locked it up, rode the market up and down, and now you're nearing retirement. And the question is, how much money can I spend? Because you don't want to run out of money, but you want to actually enjoy your life. And if you go off of this 3%, now you have access to, $30,000. And I don't know about you, but when we have this American dream and you're saving in these retirement plans, I don't know if $30,000 someday in the future is something that, you would think like you're a millionaire. Like, that's not that much money today. Imagine what that's going to be in the future as inflation makes our dollars less and less valuable. But that's not even the end goal. You have to pay tax on that money. And let me ask you this. What tax rate, what's your tax gonna be in the future? I don't even wanna ask myself, like, what would I have to pay taxes on if my money was in a 401k or an IRA? And it could be a lot less. A lot of people, a common belief is you're gonna be in a smaller tax bracket because you'll be making less money. But what they fail to realize is where our government's at, where our debt's at, and where our country's at. I think it's really, really hard to justify looking at where we are, saying that taxes are gonna be lower. In fact, in my book, I dedicate a whole chapter to talking about taxes, because I believe that taxation is the #1 threat to your wealth, and it's pretty crazy. In this example, just for math, I'll use 30%. It could be lower, it could be higher, but let's say you have a 30% tax that you have to pay for income. That's $9 grand, and so this $1 million gives you $21,000. The point that I'm making is the way that you're saving for retirement may work going up the mountain, but it's a terrible thing going down the mountain. Now let me talk about why life insurance is so powerful as it relates to having later in your life. A lot of people say, I don't need life insurance when I hit retirement because I've saved up money, and if I die, my kids will be okay. And let's just say that's true. Let's just look at this from an investment or a retirement or distribution strategy. Let's first look at, if you just look at the life insurance. If you just look at the life insurance and you spend money from your life insurance, remember, we don't have to worry about taxes. Your money will never get lost. In fact, your money is going to continue to grow to the day that you die. Compound interest gets better and better as you go on. If you remember that hockey stick example, it's going to show up most powerfully when you're taking out that money. And so because of that, because of something what I call capital equivalent value, we're able to get anywhere from 5, 6, 7% sometimes as it relates to our policies. So you could have the same $1 million, but take out $60,000 or $55,000 tax-free. Again, let me ask you this, would you rather have $800,000 in an account that you could have access to that was tax-free to get more money? Or would you rather have $1 million in an account that you got less money in? Think about it. So many people are just caring about what number they have at retirement. They're not looking at what that is actually giving them in the future. And if we just go back to result, what do we want to accomplish? We're gonna be so much more farther ahead. Now, the second strategy that I wanna unpack is what I call the pension maximization strategy. And the pension maximization strategy essentially just looks at if you have a pension account or if you have an annuity, there's certain payout strategies in both of these. And they're usually single versus joint. Now, most people that get asked, do you want a joint payout or single payout, choose a joint, because essentially they get less money, but if something happens to me, if something happens to that person, their spouse would get that other money, usually a smaller amount. And so most people are like, I'll take less money because I want this money to not, like, if I die, I will lose all of it. Well, the crazy thing is, what if that person had life insurance, a permanent life insurance policy on themselves, that if something happened to them, their money would pay out and provide for that other person? Just by having permanent life insurance, you are hedging both you have actuarial science on your side, you have the death benefit on your side, and you also have the rate of return, which will give you more money today while also protecting your assets. And because when you think about it, a joint payout is just more expensive life insurance. For those people that hate life insurance and do annuities or do pensions, they're ultimately buying life insurance when it's the most expensive. So all you have to understand is if you're gonna do annuities, if you're going to do pension, just by having permanent life insurance can give you more money while protecting your assets. And finally, the volatility buffer. There are many people watching this that are still gonna have money in the market, still gonna have money in the 401k, still gonna invest in other investments that may have a little bit more risk, but they wanna get a better rate of return. And here's what I'll say. If you have a permanent policy that has certain money that's not in the market, that will grow regardless of what happens, whenever the market does take a dip or tank, instead of taking money out from there, locking in your losses, just let your money wait to come back and take that money, borrow against it, or use your life insurance and just tap into it. Just by eliminating some of the losses throughout your life, you can actually increase your distribution pretty significantly. And so if we just eliminate some of locking in the losses, just by having a life insurance with your stocks and mutual funds could enhance the money that you want in retirement. See, I got into this business being so excited about giving the entrepreneur control over their money. And quite frankly, I'm not thinking about retirement, and that doesn't really motivate me. But knowing that this shows up really powerfully at retirement should actually factor into the rate of return. So remember, we looked at how life insurance has a better rate of return when you factor in taxes, fees, and it not losing money, and that you can access it. But one thing that we need to, the one thing calculation we need is, what if we reverse engineered from the cash flow that you got and then put an equation on what the rate of return actually is? For instance, what rate of return would you need to earn in an investment to get to $2 million if you wanted to compete with $60,000 instead of you getting $30,000? And those are the kind of questions that we need to ask, and we need to start thinking less about what we've been taught or what we think to be true, and more about what result do we want to accomplish. Hey, it's Caleb Williams here. I want to thank you so much for taking time out of your busy day to watch our YouTube videos. We put a lot of time and energy into making them informational and helpful. I also want you to know that we do this for a living. So if you're an advisor and an agent and want to learn more about the and asset and how to incorporate this into your life, check us out at theandasset.com. Also, if you're a consumer, if you're someone that wants to learn more about the and asset in your business or in your retirement plan or in your life, and asking questions like, would this be beneficial to me? We want to help you. You can check us out at andasset.com. We have links down in the description where you can get the book, you can watch different videos and learn more. We just appreciate you. We appreciate if you give this video a like, give us a comment, and share this with people that need to see this content.